We're currently seeing gold up, oil up, the dollar up, and yields up, all as geopolitics remain in focus. Now, markets are trading in a type reaction loop right now. Geopolitics impacting things like oil, which then impacts things like inflation expectations, and that spills over into other markets like FX, equities, and of course bonds as well. Now, as most of you will know, the catalyst for yesterday's price action is the ongoing conflict between the US and Iran, and the market's biggest worry right now is what it does to energy markets. On the commodity side, yesterday, crude jumped 6%, settling around that $71 per barrel level, while Brent pushed higher as well. Now, European natural gas also surged on supply risks, and gold moved like a classic geopolitical hedge up through that 5,300 level. Now, over in FX, the dollar reclaimed its safe haven role, keeping the crowd who say the dollar has lost its safe haven appeal very quiet yesterday. I think part of the dollar's strength is pure risk of liquidity demand, and there's also a structural angle noted by some analysts, noting that the US is a net energy exporter, so a higher oil price is less of a direct economic impact for the US compared to places like Europe. Now, one market that did surprise some were bonds, but we did speak about this yesterday. Now, even though bonds are usually seen as a safe haven, inflation is the bond killer. When oil prices spiked and inflation expectations responded higher, it makes a lot of sense for bonds to push lower and yields higher. For now, break-even inflation rates in the US have remained fairly stable, but if they should spike, it could put more downside pressure on bonds and could eventually spill over into other markets like equities as well. And against popular belief, the move in bonds didn't have much to do with rate expectations, as Fed cut expectations barely blinked yesterday. Don't believe everything that you read. Anyway, turning to equities, the reaction was interesting to say the least. Initially, equities sold off with all three US benchmarks pushing lower alongside European equities, but the US equities clawed back to finish roughly flat. Now, that's a very contained response compared to the moves we saw in things like oil, gold, FX, as well as rates. Now, of course, the solid US ISM manufacturing PMI no doubt offered some good news for US equities, but so far in today's Asia-Pac session, they have turned lower again. So for the day ahead, key focus will be on oil, what happens to the Strait of Hormuz, and serious escalation or de-escalation can have an implication across major asset classes. In terms of the economic data, we have EU inflation data due a little bit later, which could be a little bit more interesting if we do see a miss, especially after yesterday's euro weakness that we saw across the board. The bottom line, the market isn't in full meltdown mode, but it is repricing the cost of risk. As long as oil is rising, markets would expect the dollar to stay supported, but the situation is fluid, so do be careful out there as usual.